Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Mitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for.
Excellent.
There's a disclaimer. And let me share my screen. While I'm doing that, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it. He'll read it back to me. And to give you guys a couple minutes to put those questions in, we'll start out taking a look at the pre-market report, see if we could get insights, what's trading in a pre-market hours, and then we'll move on to the questions. All right, so the pre-market report, these are stocks that trade in a pre-market hours. Up top here, we have a calendar view, which allows you to go back to a date in history if you want to see what happened in a pre-market that date. Today, we're December 28th, and so far, this is what we're seeing. We got 495 stocks that are trading higher in the pre-market, 327 that are trading lower. As far as volume goes, we have 146 million shares trading on up volume versus 248 million shares trading on down volume. And if we convert that volume to dollar value, we have $1.8 billion worth of stock trading higher versus $883 million worth of stock trading lower. So that appears to look like the trading so far in a pre-market hours is trading with some bullish sentiment. Let's look at it from a couple more perspectives, and then we'll move on to the questions. So coming down here, now we have a list of securities by symbol that are trading in pre-market hours. We have a most active list, the biggest percentage gainers, biggest percentage decliners in the pre-market. Here we see 53 stocks made our biggest percentage gainers list, 28 on our decliners. So that from that perspective also looks like we're lining up so far in a pre-market with a bullish lean. If you look at this list, you'll see though that there are small cap stocks in there, ETFs, leverage products. And the way this list works is that to make this list, we do have thresholds in place because pre-market could be very liquid. So we have liquidity thresholds, volume, price changes, and so forth. But any security that's listed on a major U.S. exchange, if it's trading at pre-market hours, could make this list. And to narrow it down to a smaller group, we could use the filters above. Up here, if you have a watch, if you save watch list, you can filter by your watch list. I'm going to use this as an example filter in ETF. Click on it, get a drop-down menu to select from. We're going to choose SPY, which is the S&P 500 ETF. And here we see only one stock made our percentage gainers list, none of the decliners. So pretty even. And again, to make this list, the biggest percentage gainers, decliners, it has to meet certain thresholds. I guess, well, we gave it a couple minutes, so I will, take questions now if you have some.
We had I see MW's back on. I think he sent us a question. Yes, he asked it again, actually. He
Okay.
said, I noticed after I used the earnings option strategy screener, I find a strategy with a high win rate and plug it into the option chain calculator. I'm assuming he's talking about the profit calculator.
Mm-hmm.
By the way, Rob did say earlier in the chat that the prior shows on how to use the calculator are very helpful. So
Oh,
that's
awesome. Thank
thanks
you.
for that, Rob.
Thank you.
So I guess when he plugs the same trade into the option calculator, I can't the same win rate. The win rate changes, is what he's saying, I think.
Yep. Okay. Um, so all right, so I believe, just from listening to it, I believe that he's going in here, earnings option strategy screener. Okay. Tell me if I'm wrong, because unless he wants to come on a show and tell us where he's looking, um, I have to assume these are the places. But if he wants to come on a show live, tell him, we could let him into Zoom. Um, so I believe that initially you're looking through this option strategy screener, earnings option strategy screener. And in this screener, you could see there are over, we filtered, from 3 million back tests. And what this back test does is it looks at the symbol and says, okay, look at the last 12 quarters for each symbol. Right. So this is what this back test does. It looks at the last 12 quarters and of earnings, and then takes that data and looks at different strategies around those earnings periods. Okay. So you could see here, if I drop it down, you get a list of different types of strategies that this runs, like, calendar spreads, buy rates, debit spread, credit spread, straddle, strangle. So it looks at all these strategies and just runs them, so you don't have to do each one individually, and you could compare them versus each other. And then it takes a snapshot of those historical data points. So like here in the symbol A, I think this is in alphabetical order, right? Which is Agilent. They'll say, take a look at the 25 delta call. So that's the strategy. And if we looked at the 25 delta call and we looked at it the day before earnings, and then looked at the same call, the value. So one day before earnings, end of day, and then it looked at the same call, end of day, the same day it reported earnings, right? And then it calculated how did that call perform, right? So if we found a 25 delta call, it was, let's say, $1 right before reporting earnings, end of day, and then the next day that same call at the end of the day was 50 cents, it would have lost half its value, right? If it was up, if it went from $1 to $2, it would have gained 100%. And then, so it does that for the last 12 quarters, right? So it's like 3 years of data, because remember, earnings are like once a quarter. So you can't get, daily. It has to find those dates. Does that, and if you open it up here, if you click on it, here's the data, right? So it tells you the dates, tells you where the call was before, what the call was after, what the return was, what the stock did, and these are the last 12 quarters. And if you wanted to see the options chain, you click on there and it shows you the snapshot. All right. And so let me go back, close this. And then it tells you, okay, just that strategy alone, how did it perform? Like if we just took the last 12 quarters, like what does the stats look like? All right, for that strategy. So you could see here that was a winner 25% of the time, an average return of 1%, negative 1%. Right. So the the median return was negative 73%. This is the best, return worst, standard deviation of returns. Okay. So then it does it for other strategies, right? For call buy right, short 25 delta strangle. So you could see your debit call spreads. So you could kind of compare, and I think I could just filter it out by symbol too. So this is for Apple. So I could compare and just kind of even different hold periods. So we could look at the same strategy, but let's look at it from different hold periods, right? And this just gives you a sense of how those strategies performed in the past, and you compare them versus each other, and you could just see the returns. How extreme were they? How frequent were the wins? How frequent were the losses? The best and worst. And this gives you a sense of the performance, the volatility, the distribution of the returns and so forth. Okay. Again, we don't know what will happen in the future. This is just looking in the past, so we could study this ahead of time. If you're interested, well, how did the credit put spreads do? Did they tend to do well, not do well? So you could get an answer here really quickly. So instead of going by hand and doing each one of these individually, the idea here is this whole report is doing over 3 million backtests for you, right? So you could go and find the answers here quickly. Or you could just filter by certain strategy type if you want, just select it here. So what is this win rate? Again, this win rate here shows the historical, win rate of that strategy using those historical snapshots, right? Where did it close? So from close to close, right? That's what it's doing, look, from close to close. So think of it as, stock closed one day here, stock closed, how did it perform? So that's what this is doing, it's taking snapshots from close to close for these date ranges, for these different strategies. So then what if we went and to the options chain and set this up, right? So the question is, well, what if I want to do this call spread in Apple, right? This call spread, if I set it up, right, and I evaluate the strategy, well, that's a different type of analysis, right? So you're not doing now you're going to a different type of analysis, all right? So you're not looking at a historical a summary stat of historical data. Once you go to the options chain, you're like, okay, I'm not looking at the historical options data anymore. I'm trying to evaluate the options that I'm seeing right now. Okay, now I'm not even looking at the historical options data anymore. I'm looking at the present. So the present, isn't even in here, right? These are all historical. So what if we go to the options chain? Let's just pretend, Apple's not coming out with earnings or anything. Now I'm going to the options chain. And let's just say, in January, I am setting up a call spread, right? But let's say the 190, 195 call spread. Okay, 190, 195 call spread. So here's a call spread, and I calculate it. Right now, I see where today's call spread is. So keep in mind, this has nothing to do with historical options data anymore. I'm looking at the present options data. That's it. Now I'm looking at the present options data, which is not even in that historical data points, right? Because today's prices are today's prices, right? They could be anywhere. And now based on today's prices, I'm trying to evaluate, okay, I know the risk reward, this is the payout diagram, but I'm trying to say, is today's price, if I'm paying $2.88 for this call spread, right? Well, how does that look based on historically how the stock performed? So it doesn't matter where the options were, because the options are not right now, relevant to this. Right now, I'm looking at, well, if I hold this till expiration, right, 288, how does the stock usually perform? And how often does, the stock behavior, end up, so this would be profitable. How often is it unprofitable? So this win rate here, okay, is looking at the stock performance, right? And saying, well, what does the stock have to do? It has to be above, by expiration, let's say, above whatever, 3% or whatever it is to, so how often does that happen? And that's what this win rate is. Okay. So this is not looking even at historical options data. It's just looking at, here's today's option values. And if I want to evaluate today's options values versus how the stock usually performed, given the similar circumstances of this, right, of what we're going on, the strikes that I selected, right, the days to expiration, is there an earnings covering it? Because now I'm like going into a options options change with current prices where, what's going on today? How far am I from earnings? How far away are the strikes that I picked from spot price? How often does the stock, move above or below? So that's what we're doing here from the options chain. And we could also compare it to IBKR. All right, so there are a couple different ways to run a valuation model on today's option prices. Okay, so I guess, the so when we're doing these analysis, it's important to understand, well, what is the data that I'm analyzing, right? Like, what is the data set that I'm analyzing? Because the data set that you're analyzing makes the difference, right? If you're analyzing two different data sets, and their inputs into a model, where you're going to get an output, and the output is not going to, it does not have to be the same, because now you're using two different sets of data, two different potential models, and those outputs could be different, right? It gives you a different answer to a different question, right? It's two different questions that you're asking, right? One is, how did a particular strategy perform in the past? Another question is, well, if I set up this strategy, if I set up a particular strategy using these market prices, and then I ran an analysis based on how the stock performed, how do those two compare, right? How do the market prices compare to a theoretical value, right? A theoretical value of the theoretical value based on how the stock performs. So hopefully, without knowing where he's looking, this is what I'm thinking he's trying to do.
Yeah, no, that was super helpful. He actually said that clears up everything. So that was great. We did have Michael McCrae ask a question. We've got about 10 minutes left. He asks, how is it that Delta shows the approximate change in option price based upon the underlying, and at the same time also shows the theoretical percent of option being ITM in the money? I think he's asking.
So, when so here are the deltas of these options, right? um, and when we look at, so the delta of an option it's a derived value based on an option pricing model. Okay, it's a derived value. It's not given. It's not like, the exchange doesn't give it to you, because it's just something you have to calculate, and you're working backwards from, your inputs. So so think of it, your inputs are, the price of the option. So, even over here is the price of the option $1.48, is it $1.50, is it in the midpoint? You know, your days to expiration, your interest rates that you use, the dividend assumptions, all this stuff. So you're putting this into the option pricing model, and then the model, it produces this delta. Okay. Now the model, the way it defines the delta, it doesn't define it. It's not the probability of this finishing in the money. That's not how the Greek, the delta, is a risk metrics. Okay, so don't think of it as the model's telling you the probability of this being in the money. That's not what it's telling you. What it's telling you is that, given our assumptions, okay, it only tells us one thing. It doesn't tell us two things. It tells us one thing. Given the assumptions we put into the model, right, that the delta of this option, for example, here, is 0.27, meaning that if nothing else changes, right, so all the inputs that we put in the model are constant. Days to expiration, they're stationary, right? They're not dynamic, they're stationary. Everything we put in the model is constant and stationary. Days to expiration, interest rates, all this stuff. Then, and if it stays that way, then if the stock moves $1, right, then this option is expected to change by 27 cents. So in the call, right, in this instance of a call, it's expected to move up by 27 cents if the dollar moves up. If the stock moves up $1, and it's expected to lose 27 cents if the stock moves down $1. That's what it is. That's what the delta is. Delta, think of it. Even the name delta is rate of change, right? It's a rate of change it's like a slope, one versus the other, right? So it's a rate of change. How much will this change based on the change of this? That's the delta. The model doesn't tell you it's the probability of it finishing in the money. That's how people start to use it as a kind, because you could try to calculate probability of it finishing in the money or whatever, but they're saying if this is the delta, then this is the close probability. Okay. But the option pricing model focuses on two things. It focuses on valuation. What do I think this option is worth based on my inputs? Right. So it's kind of it's a way to come up with, what do I think this option is worth if I assume this, this, and this, right? So if I assume here, I'm going to use the option pricing model right here. If I assume that the implied volatility, or the volatility of the stock, right, is, let's say right now it's 17 on the implied, but let's say I think it's 18, right? 18. And I'm going to apply 18 vol to all these options, right? If I assume 18 vol, I'm going to change that. Then theoretically, this option should be $1.65. That's what this is, right? This option should be $7.97. And that's according to the option pricing model, assumptions. So that's one thing it does. So it allows you to change assumptions to come up with a value for the option, which is valuation models are one of the paramount factors to trading. How do you, what do you think this is worth? If you're trading something, you have to think of, what do I think this should be? The price. Am I getting a discount? Am I overpaying, and why? So that's one thing it does. And then the second major components of the option pricing are breaking down the risk factors. So you need to understand your risks, and it'll break it down: the delta, the gamma, the vega, the theta, the rho. All these are ways that you should be managing your risk, right? So managing and mitigating your risk as much as possible. So those are the two things that it concentrates on. So it's not a prediction. Okay, it's not a prediction model. This is going to go up or down, right? That's not what it's doing. It's not saying that, oh, the price of Apple is going to go to 200. It's not doing that. It's not saying the probability of this going to here. It's not doing that either. It's concentrated two things. One is, can I come up with a fair value or a theoretical fair value for this option and compare it to the market to see, like, hey, is the market on the low end or high end, or do I disagree with the market? So that's one thing. And then it gives you the tools to start to mitigate your risk or know your risks exposure, right? So you have a sense of, what kind of exposure do I have? Does that mean that if the stock goes up $1, this will definitely be up 27 cents, or this will definitely be down 27 cents if the stock goes down $1? No. Keep in mind, these are not like absolute definite things. These are ways to mitigate your risk that you're getting close to, right? If nothing else changes, because things are dynamic. If the stock moves up $1, implied volatilities could move in. Time has passed. So the option, could be down even more than 27 cents, or it could be, it could be up, by less than 27 cents, or it could be up by more than 27 cents, because then other factors are playing in. But it's trying to break down your risk exposure, because to mitigate your risks, right? To mitigate your risks, you need to get approximate, hedges on there. You're not going to get it. You're not going to mitigate it. Like, it's not going to be 100%, that this will definitely move up 27 cents, down 27. It doesn't work that way, because things are dynamic. But what it's doing is getting you close. Maybe it'll move up by 25 cents or 24 cents, or maybe it'll move up by 29 cents or 30 cents. But what it's doing is giving you those numbers that you're pretty close to what is probably going to happen most of the time. Is that helpful? So if you're thinking about it and say, hey, I think that the stock's going to go up $1 in the next hour. Well, what do I think this call could go up by? Oh, well, the delta's saying about 27 cents.
Yeah, I hope that helps, Michael. Michael did say, I have attended many educational options videos or classes where they talk about delta being used as an approximate percent chance of being in the money, even though the model may not be designed for those purposes.
Yeah, I know that it does, but I think that, when the way I see it, though, I think that those classes that you might be taking, I think that unfortunately, then then I think that people then are just approaching the delta in the wrong way, in my opinion. Then, but you could read, besides the class, you could go and actually take the Black-Scholes model. It's published. It's out there. You read it yourself. You could derive it. You could you'll be able to derive this value in Excel, and then you'll be able to decide for yourself.
There you go. Awesome job. And
Here, like, let me just to give you an example here. You know, when people think of it, the delta O, like if I have a 100, people think, oh, if I have a one delta, I have a 100% chance of uh making money. That's how people are thinking, right?
ooh,
Like you're
nickels
thinking
in
like
front of
20,
steamrollers here.
yeah, huh?
Picking
Yeah,
up nickels in front of steamrollers.
yeah, like here, like this is how people imagine. If this is 27 delta, oh, we'll have a 27% chance of making money. That's how people are perceiving. But think of it this way: here's a one delta, right? This delta is one. So this option is going to move one for one with the stop. But this option doesn't have 100% chance of making you money, right? It's just saying that it's moving one for one with the stock. That's what this is saying. That is just moving right now, one for one with the stock, uh, given all the circumstances at this moment, right? At this moment, it's moving one for one with the stock. That's kind of like where the delta, right? Because otherwise, you could just buy one deltas if you think it's, you know, it doesn't think it's going to move far enough. Yeah, with this volatility, doesn't think it's going to move far enough, for this, option for the stock to go below that.
All right. Perfect. Awesome job, D. Thanks for the
Okay.
questions, chameleons. Have a great day, everyone. D, you
All
have a
right.
good day, my
Thanks
friend.
everyone for joining. Stay safe out there, and hope to see you guys tomorrow.
Trade in peace, chameleons, everyone.